Welcome traders. In today's video, I'll be laying down the foundation for your trading success. We'll tackle key issues that many traders face and explore essential tips to help you overcome challenges and take your trading journey to the next level. Let's dive into some crucial steps that will help strengthen your path to become a better trader. Throughout this video, we're going to go over some key areas that we should always keep in the back of our mind when we're trading. One will be strategy hopping. The second will be overtrading. The third will be emotional trading. And the fourth will be risk management. We're going to cover a few more topics as well, so make sure you stick around and take some notes. So what is strategy hopping? Supply and demand, order flow, smart money concepts, all of these are examples of different trading strategies. Finding consistency in one strategy is important. If you continuously bounce between strategies, your results will never be accurate. If one day you're trading supply and demand, and in a few more days you're trading order flow, a few days after that you're trading smart money, a few days after that you're back to supply and demand, you're never going to get consistent results when it comes to your journaling and feedback on your trading. Many traders think their strategy isn't working after a few losses, leading them to abandon it. How can we fix this? Give yourself at least 1 month with one strategy. That way, with that time, we have time to adjust our strategy and get more accurate results. We can create a pre-market plan. This includes finding levels, zones, having a higher time frame bias, finding trends, and finding ranges. We could create a morning checklist, develop a consistent pre-market routine that includes checking news, analyzing charts, and setting trade alerts to start your day prepared and focused. We could check news and economic reports, review the latest news and economic data releases that could impact the market. We could analyze pre-market activity, look at pre-market charts to identify key levels and potential trade setups, and we could also set alerts and goals. We could define our trading goals for the day and set alerts for key price levels on market events. That way we don't have to be staring at our screen. With the alerts, it will let us know when we are at a specific price. Overtrading. Overtrading is one of the biggest killers of an account. If you feel like your chart is looking like something like this on the right hand side, you have to take a step back and really start giving yourself some better rules to follow. It's important to understand that only you control your own losses, whether it's with a stop loss or having a max number of trades you can take in a day. Temptation to take more trades. The belief that taking more trades means more opportunities for profit is completely wrong. If you gave yourself a set 3 trades a day and you got 2 out of 3 right and you hit X amount of profit, if you take another trade, you're increasing the chances to lose money. Whereas if you were to cut your losses or cut your day at that 3 max, you would no longer be running into that risk. Overtrading also weakens focus. Overtrading often leads to taking low probability setups, decreasing our overall performance. Instead of looking for just a plus setup, something with a good risk to reward, we're now trying to scalp any move for momentum. We think every candle's going to continue, and we're not being focused. Emotional burnout. We have to remember the mental fatigue from overanalyzing charts and executing too many trades can lead to costly mistakes. The more trades we take, the more of a chance we're going to lose money. It is not the other way around. Emotional trading. Don't be emotional. Emotions play a role in everything from our day-to-day lives, whether it's trading, waking up in the morning, taking care of our pets, taking care of something around the house, running some errands. Emotions are a part of life, and we have to accept that. Greed, fear, and revenge are the 3 biggest emotions that influence bad trading decisions. Fear causes you to exit winning trades a little too early. Greed can lead to holding on to a position too long, hoping for either bigger gains or for a red trade to come back green and we end up holding a loser for too long, and revenge trading after a loss, trying to win back what we lost, often results in doubling down and compounding losses. And all we're doing at that point is taking one loss, turning it into two, into three, into five, into a blown account, and we cannot be doing that as traders. Now that we went over some pre-market prep and the emotional factor of trading, let's talk about risk management, which we have covered vaguely over the past few slides because, quite honestly, it's nearly impossible to talk about trading without mentioning any type of risk management. As we see on the right-hand side, we have a risk to reward and win rate cheat sheet, where it shows us our risk to reward on the left-hand side. We are risking 1 to make 2, 1 to make 3, 1 to make 4, and 1 to make 5, and we have our win rate percentage. And as we see, the higher our risk to reward is, the lower our win rate has to be to remain profitable. And this gives us an upper hand as traders, so if we were to go through a losing streak, we're not going to be blowing our accounts. We have to remember that even the best traders experience losing streaks, but the difference between those best traders and somebody who's new is they're not blowing their accounts, they're properly sizing, and they're even sizing down when they notice the market isn't moving in their favor. Effective risk management isn't just about setting a stop loss. It's about controlling how much of your account is exposed on any given trade. You're not just protecting your capital, you're also safeguarding your mindset. When losses are small and manageable, you're less likely to trade emotionally or chase after bad trades in an attempt to recover quickly. Journal your trades. Guys, everything all wraps together. As we just heard, I was talking about risk management and how it's not just about a stop loss, it's also about safeguarding our mindset. Mindset comes into risk management comes into mindset, journaling comes into trading, into mindset, into risk management. So it's important to track and journal your trades. It is essential for your trading growth as it allows you to spot patterns, fine-tune strategies, and hold yourself accountable to your trading process. Why tracking matters? Without proper tracking, it's impossible to know whether you're improving or making the same mistakes repeatedly. Data-driven decisions by tracking will help us see patterns in our trading behaviors, like seeing certain setups that work better than others, or seeing that there are impulsive trades that are leading to losses. Long-term improvements as well, we could review our trade data, which gives us clearer insight into how our trading is working and where adjustments need to be made. So what can you apply to your trading? Well, you can always start with your pre-market plan and levels. You could set a daily trade limit. You could stick to just one strategy, no more strategy hopping. You could apply proper risk management. You could trade without emotion. We have to disconnect from the money, have to disconnect from our trades. If you feel there's too big of a connection between your emotions and your trading, you probably have to size down. And we could journal our trades. I can promise you if you do 5 out of the 6 here, let alone 6 out of the 6 here, you will see an improvement in your trading. Drop a comment below. Let me know what you guys think. Hit that like and subscribe button. I'll see you guys in our community. Check us out at bullishbears.com. Take care, happy trading, and have a great day, everyone.